Tonight, we're zooming out and talking about the big picture, the stuff you absolutely have to do if you want to manage your own money in the stock market. Before I get back into it, let me just say that if you don't feel like reflecting on what you need from the stock market, if you don't want to do the homework, if you don't want to watch the underlying companies and give up on their stocks when something goes wrong, nobody's forcing you to do that. There is no gun to your head. It's okay if stock picking is not for you. And that's why Vanguard invented index funds. It's why the Dutch invented bonds, for heaven's sake. You got plenty of other investment options. So if you're going to play the stock market, and I use the word play pretty loosely, if you're going to invest in it, all right, then you should put in the effort to do it right, don't you think? I think stocks are the greatest engine of wealth creation in history. And you can harness that engine, make it work for you, if you know what you're doing. All right. Now, a lot of this comes down to discipline, the stuff I've been talking about all night. But there's another ultra important component here. Call it the emotional side of the equation. You need the right attitude toward the market, because without the right attitude, stocks will break you. I mean, this is a brutal game, and you need to make sure you got the right headspace if you're going to play it. I cannot stress this enough. For many of you, managing your emotions will be the hardest part of investing. Harder than even picking winners. Harder than identifying new trends. Harder than knowing when to cut your losses. Why? Because the market is a harsh mistress. At times, owning stocks can feel like being in an abusive relationship. But we just keep coming back because long-term, it is a great way to try to make money. The thing is, unless you can perfectly predict the future, you're going to make lots and lots of mistakes. It's inevitable. And when mistakes lose you money, that can be very tough to handle. You need the patience of the Dalai Lama to not get upset when you buy a stock and it falls off a cliff. Imagine what it was like for me at my old hedge fund. Before I mellowed out, I was the opposite of the Dalai Lama. When I got something wrong, I would flip out. You did not want to be around me on a down day, especially if I was way too long. So I can tell you from experience that this is not a productive attitude. You know what? If you did read Confession of a Street Addict, you would know exactly the wrong attitude. I know better than, well, I still made a lot of money, but I was hell to live with. I know better than anybody that you need to try to remain calm, because constantly getting mad at yourself just is not sustainable. You'll beat yourself up. It's crazy. You'll end up running out of patience and giving up on the whole asset class. Look, I'm not telling you to be the Dalai Lama. You don't need to be a Buddhist monk to be a good investor. It's okay to get mad or sad when the market punishes you with its behavior. I still do. An Action Alert stock, that stock that my Chapel Trust owns, if it gets really hit, I feel awful. I do. I can't get it out of my system. But you know what? I have to. You can't afford to punish yourself. The market's brutal enough on its own. In other words, get your head on straight. Your head matters in this game. You need to have it on right every day if you're going to spot opportunities and act on them. Yet so many of us approach the market with, let's say, an inferior attitude and an inferior state of mind. Our heads are clouded by negative thoughts that genuinely throw us off target, making us do the wrong thing. You will be in the wrong frame of mind to spot the next opportunity. So let me be your stock market therapist for a moment. There are a lot of harmful recurring thoughts you can have that will mess with your judgment. But the worst of the worst, when you think to yourself, if only, as in, if only I'd acted sooner on electronic arts, or if only I pulled the trigger on NVIDIA ahead of that quarter, or if only I'd stayed short Chesapeake Energy, I could have made a fortune. Don't get hung up on that. Don't get hung up on the woulda, shoulda, couldas. This is wasted, damaging emotion we're talking about. It's destructive to the positive psychology you need when you're making investment decisions. For a long time, I took it to an extreme. I would sit and be mesmerized by a couple of big misses, by things that I got wrong. I would be obsessed, going over the big miss over and over and over again. It wouldn't just be over. I can put it out of my head for Action Alerts now in a couple hours. I'm talking about days on end. Not anymore. I don't do that. Took me a long time to learn, but eventually I was able to see just how destructive playing the woulda, coulda, shoulda game can be. If you're an emotional guy like me, you may need to trick yourself into a more productive pattern of thought. I've had to build in all sorts of methods of tricking my mind into not playing this game, chiefly removing the stock from my desktop and my mobile stock list. Just going in on my, just taking it right off, okay? You look at it every day when you scroll down, you see it, it brings up that bad thought, get rid of it. Just clear it out. If you like it so much after you sold it, go buy it back, for heaven's sake. But don't tell me what you could have done or should have done. You didn't. Whether you walked into a big loss or missed out on a big gain, it's irrelevant. Stop beating yourself up, for heaven's sake. Bottom line, the stock market can be punishing enough. You don't need to make things harder by punishing yourself. Don't play the if-only game. If you need help curbing this kind of destructive thinking, go to that extreme. Take the stocks off your monitor or your portfolio watch, off your cell phone. You'll be surprised how much better your decision-making becomes when you stop the woulda, shoulda, couldas. Devin in Florida. Devin.
Hey, Jim. How's it going?
Real good. How about you, Devin?
Good.
What do you got?
All right. So I'm 25 years old and maxing out a Roth IRA. And I know you've always suggested investing in low-cost index funds. My question is, should I be 100% of my portfolio in an S&P 500 index fund, or should I be using multiple index funds to build a diversified portfolio?
Well, I actually think that what you ought to do is think of it like this. I think that you should put the preponderance in an S&P 500 fund. That's terrific, low cost. And then after that, pick one or two. I don't want you to be a mutual fund of mutual funds. That makes it even harder. Just basic bedrock, S&P, and then a couple of others. Maybe you like healthcare, maybe you like tech. That would be my choices. Michael in California. Michael.
Hey, Jim. Thank you for taking my call.
Of course.
I had a question about 401k plans. My company just put out their 401k plans, and being a novice when it comes to those kinds of things, I just wanted to know what percentage of my paycheck would be a good starting amount to contribute.
Whatever the max from your lab. Because what happens is that if you use the power of time, the power of compounding, you will have so much more, but you got to put it all in. And I always advise people, take the max, take the max, take the max. Enough with the woulda, shoulda, coulda, people. Don't play the if-only game. You'll be surprised how much better your decision-making becomes once you stop that. Much more Mad Money ahead. To quote the great Cyndi Lauper, I see your true colors shining through. It's not just a great song. It's sage investment wisdom, I'll tell you why. Then, I'm helping you find the bull market no matter where it might be hiding. And I'm answering the questions you've been sending me on Twitter. Stay with Cramer. I get to fight for real people. Norman in California. Norman. They come to me and they trust me. And they're rooting for me to be as good as I can be. I love that.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.